Yeah. So aggregate demand is a schedule or curve that shows the amount of real output, real GDP, that buyers collectively desire to purchase at each possible price level. So it's downward sloping, and it's the negative relationship between price level and and real domestic output. So yeah, so shifts in the 80 curve happen. So it shifts right and left based on many different things, and we'll go through those. So aggregate demand is determined by consumer spending, consumer wealth, household borrowing, consumer expectations, and personal taxes. So I'm going to ask the class, what would happen to aggregate demand if consumer wealth goes up? Would it shift right or left? Yeah, right. That's great. Yeah, exactly. So yeah, it would shift right if so yeah, 80. So 80 is aggregate demand, shifts right. That's great. Good job. Good job, you two. And then what about household borrowing? What would happen to aggregate demand if household borrowing goes up? Where would it shift? So it would actually shift right because they'd have more money to spend on like products and services. So they'd be borrowing to invest or put it into buying things. So that would help the economy. But so then what would happen to aggregate demand if consumer expectations changes? Like if consumer expectations become more positive. Good try. So it shifts right because if they're more positive to buying, then they're gonna buy more. So the aggregate demand would shift right. And then what about if personal taxes go up? What would happen to aggregate demand? Yeah, exactly. So like yeah, 80 would shift left because they would spend less on the economy. Like they wouldn't be buying goods and services or investing, they'd be sending it to the government. So great job. Great participation. Thanks for this participation. Uh so then so investment spending. So what would happen to aggregate demand if there's positive expectations about future business conditions? So in that case, 80 would shift right because people are more optimistic. What about if there's better technology? Yeah, exactly right. That's great. Great job. So yeah, right, because things are more like efficient. Um, what about if there's more excess capacity? So like we'll just leave that one because it doesn't really come up. What about business taxes? What would happen if business taxes go up? What would happen to aggregate demand? Yes, exactly. That's great. Good job. Great job. Great job, everybody. Yeah, great job, Lauren. Great job, Ethan. Great job, Nolan. Great job, everybody. Excellent work. So then, so when government spending increases, aggregate demand increases, as long as interest rates and tax rates do not change. So if interest, so yeah, that's a good, yeah, that is a good, like they have to keep that constant. So that's a good, I like how Jason, so Jason is a friend. He put this together. I like how he said that interest rates and tax rates do not change. So that's important because so this is kind of like what's happening in Russia right now. So they're increasing. So Russia is increasing government spending on military, right? So currently they spend 67 billion on military each year. However, they are increasing interest rates. So the increase in government spending will increase GDP. However, the increase in the interest rate will reduce GDP through lower borrowing. So yeah, like that's a good case for this. Like that's a really good case for this situation, the Russian case. So yeah. Then so that's a good special case there. So then government spending decreases, aggregate demand decreases. So like you can't spend as much on transportation, healthcare, education, military, etc. So that's what they call austerity. So net export spending is netting national income abroad. So that's when they sell products from like Canada to the United States. So with dollar depreciation, what happens to exports? Does exports go up or down with dollar depreciation? Yeah, that's great. Great job, Ethan. So yeah, it goes up because exports go up because the products from our nation are cheaper now compared to other nations. So what about dollar appreciation? What would happen to exports with dollar appreciation? Get down. That's great. Great job, Ethan. So exports would go down because it is more expensive for other nations to buy our products. So that's what happens. Yeah, exactly. So so in this case, Russia. So Russia's trying to appreciate their ruble. With an increase in the interest rate. And the reason why they're doing this is because higher, so because currency appreciation increases imports. However, the ruble is dropping substantially last few weeks. So what they're doing with their interest rate isn't working. Like they're trying to raise their interest rate to raise the value of the currency, but it's not working because their whole economy is just falling. Like it's just their full economy is being destroyed. So their interest rate strategy is not working. But yeah, it's they don't have any like the cutoff in the global payment system and global economy that's been too large that they can't stop it. Yeah. So then aggregate supply is a schedular curve showing the relationship between the price level of output and the amount of real domestic output that the firms in the economy produce. So yeah, it depends on 3 time horizons: immediate, short run, and long run. And then aggregate supply in the immediate short run. In the immediate short run, both input prices and output prices are fixed. So that's a good thing that's an important thing. So you can't, so they don't change in the short run. Yeah. And then the immediate short run, the aggregate supply curve is horizontal at the economy's current price level. So the firms can do they have a lot of choices in the short run, in the immediate short run, because they don't have to worry about price changes. So this is how this is the immediate short run supply curve, aggregate supply curve. So the price stays constant across all levels of GDP. So the firm doesn't have to worry about costs changing in the immediate short run. So that's good for them. But as the long run approaches, they have to worry about costs changing. So aggregate supply in the short run, that's after the immediate short run. So the short run begins after the immediate short run ends. And the short run is a period of time during which output prices are flexible, but import prices are either totally fixed or highly inflexible. So in the short run, output prices start to change, but their costs don't change. So like their costs stay basically the same in the short run, while their output prices can change. So then the upward sloping aggregate supply curve shows a positive relationship between the price level and output. So as prices go up, output goes up. Yeah. And it's curved. So yeah, it's a curved curve. Yeah. And then a long run aggregate supply, both output and input prices are fully, like, they can change. So yeah. So it's vertical in the long run because the long run aggregate supply is vertical because price level for inputs and outputs change. And then so aggregate supply. So what would happen to aggregate supply if costs increase? Good try. So what would happen is aggregate supply would go down. So aggregate supply would shift left, go down because the company cannot afford as much production because they cost more to produce. So what about price of imported resources? What would happen to aggregate supply if the price of imported resources went up? Yeah, exactly. So it would be this. Yeah, great job. Excellent. So yeah, it would be the exact same rationale. So for both, the same explanation. So like they wouldn't be able to afford as much production because their costs would increase. Yeah, so it'd be the same explanation. And then what about so we've done taxes before. What about subsidies? What if subsidies went up? What would happen to aggregate supply? Yeah, exactly. So they'd have more money to so like with subsidies increasing, the company would have more money to invest in production. Therefore, aggregate supply AS would increase. That's great. Great job. And then what about government regulation? What if government regulation becomes more strict? What would happen to aggregate supply? Yeah, great job, Erica. So yeah, we'll go down. Yeah, go down. So aggregate supply would go down because higher government regulation would make it harder to produce a lot of production. So that's great. Great job, everybody. So this is how the aggregate supply curve is drawn. So like as real domestic output GDP goes up, price level goes up. So yeah, input prices. So like the resources include labor, capital, and land. And yeah, so that's a big part of it. Then productivity is real output per unit of input. So increases in productivity reduce costs, decreases in productivity increase costs. Productivity equals total output divided by total inputs. Per unit production cost equals total input cost divided by total output. So equilibrium occurs at the price level that equalizes the amounts of real output demanded and supplied. So at the intersection of AD and AS is the equilibrium price level and equilibrium real output. So what would be the equilibrium here based on this chart, everybody? Mm-hmm. Great job, Erica. That's correct. It's 510. That's great. Great job. Yeah, 510. So yeah, this would be the equilibrium. So it's when real output supplied and real output demanded are equal. So that's equilibrium. So this is what it would look like if you graphed it. So yeah, so this would be equilibrium right here. And yeah, so that's where we want to be. So yeah, the equilibrium price level 100, the 510 billion of real output demanded matches the 510 billion of real output supplied. So that's where the market goes to when, like, in the long run. So this is where the market goes to in the long run. It takes a while to get there, but yeah, this is long run. This is long run. Yeah. So in the short run, there could be a shortage. So right here, the demand is 514. Then the supply is 502. So there's a shortage of 12 billion. So there's a shortage of 12 billion here. So that's short run. So you can have you can have a shortage in short run, right? However, long run there is equilibrium. So long run is usually equilibrium. So this is an inflationary gap. This is where aggregate demand increases. So this can lead. So this is where the economy grows, but there's too much increase in prices. And then this is what they call a deflationary gap, where the economy shrinks, it gets smaller, and usually the price level goes down as well. This is why. So here, this is why, like, so like a deflationary gap, recession. So deflation is negative inflation. So like the Bank of Canada, they never want deflation because it is worse than inflation. So like they want inflation to be 2% or between 1 to 3%. They don't want inflation above that. They don't want inflation above that. However, negative inflation is the worst outcome. Like in their view. But that's debatable because what we're experiencing right now with inflation, with gas prices, it's people aren't going to be able to afford to drive. So this is like the worst inflation crisis we've seen in 30 years, because inflation 30 years, like more than 30 years ago, like 30 years ago and like before then, that was when inflation was really bad. But ever since, we haven't had inflation like that until now. Like 30 years later, we have inflation like we did before 1992. So what we're seeing right now is a real problem that the government has to deal with effectively. So yeah, effects of a leftward shift in AS are doubly bad. Output decreases and price level increases. So this is when they can't. So if aggregate supply shifts left, this is called push inflation. This is called cost push inflation. So this is when so like costs for businesses increase. So like cost of labor, resources increase. Therefore, they cannot produce as much as before, and the price of their product goes up. So that's what happens here.